Welcome back, I'm Dhesi, and if you're managing risk this week, you need to hear this before the open. So here's what matters this week. The Fed meets on Wednesday, the Bank of England meets on Thursday, the ECB also meets on Thursday. So that's three tier 1 central banks in 48 hours. And every single one of them is walking into a room where Brent crude is sitting at $100 a barrel, and the Strait of Hormuz is still a live threat to global oil supply. So that's the frame for everything this week. The data does matter, the decisions matter, but the question underneath all of it is whether any of these central banks can cut rates when there's an oil shock. And the honest answer is they probably can't. So the oil shock is not over. Brent is currently sitting at $101.5 on the board today. And the path it took to get there tells us more than the level itself. So it swung from nearly $120 at the start of last week down to just under $80 on Tuesday, and then stabilized around $100 back end of last week. And that is not a market in control of the narrative. That is a market repricing a risk it doesn't fully understand yet. So the mechanism is the Strait of Hormuz, the choke point that carries roughly a fifth of global oil supply and liquefied national gas trade. Iran has intensified attacks on energy infrastructure in the region. The IEA has also announced that the strategic reserve will be released, but the market is not buying that relief. Well, not fully yet. So wholesale gas is even more elevated, more than 50% above pre-war levels, as per a report I saw back end of last week. The implication for anyone managing energy costs, hedging programs, or Q2 input assumptions is direct. If you built those assumptions before the conflict started, they are already stale. The energy shock is not a tail risk to be monitored. It is the operating environment we are in now. So, three central banks, one impossible room. The Fed on Wednesday, and they're expected to hold. Under normal circumstances, last week's US labour market data might have brought an early cut back onto the table. But with Brent at $100 and the inflation outlook clearly skewed to the upside, the Fed's calculus changes entirely, and they are not going to cut into an energy shock. Bank of England on Thursday, they're also expected to hold. UK gilts have risen sharply over the last 2 weeks. Term premium, the extra yield that investors demand to hold long-dated debt, is elevated and rising. And also the MPC is watching energy passing through to that UK CPI extremely closely. And the honest answer is that this oil move makes any near-term cut harder to justify, not easier. ECB also on Thursday, and they're also expected to hold. The ECB's disinflation narrative had been building nicely, and then Brent spiked. And the energy channel into Eurozone headline CPI is direct and fast. Thursday's decision is likely a hold, but the press conference language will be everything. So listen closely to that. Any hint that cutting pace slows and the front end reprices immediately. Running underneath all three, markets are scaling back the rate cuts for this year. The energy shock is doing what it always does, complicating every policy in the room, lengthening every pause. So, rates are not behaving. Here is what I keep coming back to. In a standard geopolitical shock, you expect safe haven flows into government bonds. Yields fall, rate price in more cuts. That is the textbook response. But that is not happening. Dollar 10-year swap rates are at 4.07%. Sterling 10-year at 4.6%. Euro 10-year at 3.01%. So rates are elevated. And the curve is not sending the message you would expect it to in a risk-off week. So this is the stagflation signal. Inflation risk from the energy shock is winning the narrative battle over safe haven demand, which is for duration. And when bonds do not rally into geopolitical stress, it tells you the market is more worried about prices than growth. For anyone managing a fixed versus floating decision, this is the week when the picture clarifies. 3 central bank decisions, US PPI on Wednesday, UK labour data on Thursday, all of it feeding into the curve in real time. If the data comes in hot and the central bank sounds more hawkish, the rates move higher from here. So, dollar swaps, 2-year at 3.83%, 10-year at 4.07%. The curve is positive, the long end carrying a premium, and that reflects the inflation risk. Sterling swaps, 2-year at 4.27%, 10-year at 4.6%. The Bank of England decision on Thursday is the near-term pressure point. A hold with a hawkish language really would test the long end higher. A hold with a dovish signal, you get a relief rally, and that may hold into the weekend. Eurozone swaps, 2-year at 2.65% and 10-year at 3.01%. The ECB holds on Thursday, but what Lagarde says about the pace of future cuts will move the front end instantly. So for treasurers running floating rate liabilities, the hedging conversation is live and urgent this week. So 3 decisions plus the oil backdrop. By Friday afternoon, the path will be clearer than it has been today. So 2 channels this week. Dollar first. The US dollar index has strengthened further. Euro dollar at 1.14, and that is down 1.7% over the last 10 days. Cable at 1.32, and that's down 0.8% over 10 days. So the dollar is catching a bid from the repricing of US rate cut expectations. Fewer cuts means higher dollar, and that is a cleaner macro impulse, and it is continuing. Sterling faces the Bank of England on Thursday as a domestic catalyst on top of the dollar move. If the MPC sounds more hawkish, citing energy inflation risks, cable gets another leg lower. If you have dollar receivables to hedge, the level today is better than what a hawkish Thursday might leave you with. The yen is the divergent worth watching. Dollar yen is at 159.7. The yen is actually weakening despite the geopolitical stress, and that is quite unusual. So when oil inflation dominates the narrative, the yen carry unwind does not happen in the way that you would expect it to normally. So watch how this moves if Thursday's decision is a surprise. Moving on to Brent, that is currently at $101 today, up 1.5% from Friday's close. And that is a continuation move, not necessarily a spike. The market is not pricing a full Hormuz closure, but it is pricing sustained significant disruption. And that premium is sticky, as long as Iran's posture remains unchanged. Gold also tells a different story. Down 1.3% today, down 3% over the last 10 days. So when the safe haven bid in gold softens, while oil is rising, that is inflation risk displacing the fear trade. It matches exactly what we see in the rates market. And that is not pure risk off. It is an inflation shock. And the market is positioning accordingly. Equities also under pressure, the S&P 500 at 6,600, and that's down 3.4% over the last 10 days. Euro stocks at 5,680, down 2.8% over the same period. The Nikkei at 53,150, down 4.3% over 10 days, the weakest in the window. Credit spreads elevated but not yet alarmed. US investment grade option adjusted spreads at 91 basis points, US high yield at 317 basis points, Euro high yield at 300 basis points. so not at stress levels yet, but moving in the direction of caution. So watch credit into the central bank decisions. It widens before equities fully price a policy mistake. Also, crypto, Bitcoin is at 71,800, and that is up 3.6% over the last 3 days. Ethereum is up 4.8% over the same period. So at the higher beta end, it's doing its own thing. I wouldn't read too much into it against the macro backdrop. Okay, so moving on to the week, central bank decisions really dominate the calendar this week, and here's how it breaks down. So for today, we have US Empire State Manufacturing, Industrial Production, and Manufacturing Production, and that's an early read on US activity momentum, so it is an important look. Tuesday, Italian CPI, that's Eurozone inflation signal ahead of the ECB. Wednesday, the busiest day, US PPI and core PPI in the morning, Bank of Canada rate decision, and then at 6 p.m. London, the Fed rate decision, followed by the FOMC press conference. So watch the dot plot and the statement language very carefully. On Thursday, you have Bank of England MPC decision and the ECB decision, both in the same session window. UK labour market data in the morning, US initial jobless claims in the afternoon, 5 rate decisions in 48 hours. And that is a rare concentration. And running underneath all of it is the Strait of Hormuz. Any escalation or de-escalation headline can reprice Brent faster than any scheduled release this week. So do not let the calendar distract you from that. That's your week ahead. Bookmark it, come back on Friday, see how it aged. I send a daily version of this every morning on Telegram. The free link is below. Subscribe if you want the next one, and drop the one level you are watching down below.